Hello and welcome to Trading a Smaller Account. My name is James Boyd, standing in the stead for Barbara Armstrong. She's traveling this week and she will be traveling to the New York event next week as well. So I'll teach this class today and also next week as well. I started this class a couple years ago. It was in the afternoon, and then Barb took it over. And so I have talked before, started it, and then sometimes cover for Barb like now. So very familiar with this class, and I see many of you here. We welcome all of you. Mighty Mouse, Silas, Dom, Freda, Jackson, Christine, Sharon, and many others. So let's go ahead and get started. Now remember, you can follow us on X. We do post educational content and updates there. My handle is @JamesBoydCS. Now also, as we get rolling, our examples are going to be stocks and options based. Remember, when we talk about options, remember that options carry a high level of risk and are not suitable for all investors. The information provided here is for general informational purposes only. Our examples will be done in the Paper Money software application for educational purposes only. As we go through some examples, if you have questions, go ahead and ask those questions. And also remember that investing involves risk, including loss of principal. Now, in some of our examples here today, we're going to show some examples of profitable trades, but we'll show some examples of trades that didn't go well, okay? And I want to talk about those as well. Now, also, if you go to schwab.com/events, you'll actually see that we have 3 different events coming up in the near term. June 28th, next week, be a one-day event, and it's going to be a market drive event at the New York Marriott Marquis. So that's a one-day event. We have a 2-day event in New York, August 8th and 9th, same hotel. And that's first day technical analysis, second day option strategies. And also we'll be back on a 2-day event in Chicago as well. So some in-person events I want to make sure that you're aware of. Now, coming up next week, I want to make sure you're aware of something. And let me just pull this up. Let me just grab that. And what I want to show, I'll show that in just a moment here. But there's an event coming up next week. Could go like this, slide it over, and yeah, there you go. I'm going to slide this over. There you go. Now, if you go to the schwab.com/coaching and you go to live webcasts and virtual workshops, you're now going to see that if you scroll down next week, there is a special event. It's going to be done on the 20th. Let's go ahead and take a quick look at this. The 24th, and it's at 1 p.m. Eastern. Now, if I click on this, okay, click, you're now going to see that Joe Mazzola, Kathy Jones, Liz Ann Saunders, Michelle Gibley, and others will be talking about really the mid-year market outlook. Their comments are going to be really in terms of the stock market, U.S. markets, international markets, bond markets, etc. So check that out. That's going to be a 90-minute event, and let me send that out to you right there so you can see that. That's going to be next week, 1 p.m. Eastern. That is on Tuesday, okay? Now, I want to go back to this just real quick, so check that out. I'll be watching as well. Now, I want to take just a very quick look at the market. Second thing we want to do is talk about managing existing trades. Today is expiration day. We have a number of examples that I want to discuss, good trades and bad trades, and also maybe how could have those bad trades maybe been slightly averted to a degree. And then we're going to talk about setting up some new example trades, okay? Now, let's go ahead and just take a quick look at the Dow Jones. Now, just real quick, if you're not familiar with our charts, I just want to share this with you. We tend to actually have 5 charts that we kind of use quite a bit. Let me share this link with you, or the grid, I should say. And if I share that with you, if you say, I don't have that, I'm just sending it to you right now. And this is our kind of our default chart that we normally look at, okay? I'll talk about some of these other charts in just a moment, but just know that any chart that I show, the grid that I just sent out to you is really, you should have it. You can just take that link that I sent out, go to setup, open shared item, anything like, just like any normal script, open shared item, copy and paste it back in, and say preview, and then import that. That's all it is. And then all of a sudden it's going to be on your side Yours is going to pull up in terms of like a small window here. But if I maximize it slightly, there it is. And you could just go to style and then save style, okay? And that way it puts it on yours. Now, you also got to remember is you can go click on the forward arrow and it's going to take us to the next charts. So in our examples demonstration here today, we'll be going through some of these charts, and there's reasons why we don't have just one chart. There's different, just like a tools, okay? I don't have just a hammer. I have a screwdriver, crescent wrench, pliers, all on here. There's different reasons why you use different charts. And I don't like to put everything on at once, okay? Definitely don't like that. Now, what I want to do is let's go take a look just real quick. Dow Jones. Dow has been kind of the index, if you will, from a large cap perspective that has struggled, not necessarily breaking down, but kind of holding there. Now, Kevin and I were actually doing in the class prior, we talked about speaking of a different chart. I'm going to actually go back a chart. And if I go back a chart, what it's going to do is it's going to take us to that fifth chart. And I want to zoom in here, okay? Now, we always talk about really different types of trends. Well, in the last couple of days, I mean, we could see pretty clearly if the price falls down below the 10-period moving average, that light blue line, we're losing momentum. The Dow's lost momentum 5 days ago, not just today. If the price is down below both moving averages, you're going to see we call that trend one. Now, if you're unclear in terms of what is the different types of trends, we label it as trends 1 through 5, okay? Trend one, which we've been in the last, let's say, 2-3 days, we've been below, closing below, trading below the moving averages, both of them, for the last 3 days, okay? Now, when we get these green colored candles, which are your favorite color candles, we just call that trend 3, which, by the way, that went 3 for a long time. And what you're now going to notice is when we get to trend 5 is just when the price falls. You could look up and probably figure it out. But when the price falls down below the short term, it just kind of plots it there. And there's 5 again. There's 5 again. Why is it not 1? Well, because it's not 1 because it didn't get below the 30-period moving average. Why is this orange? Well, it's because it believes that it's actually trading up near an area of resistance. Now, the reason why we created this is I always hated it. Okay, ask me how I feel. When you talk to people about different types of trend, and you'd ask 10 different people and get 10 different, almost like you probably get 7 different answers, okay? So we're trying to kind of have something where we can kind of maybe align ourselves in evaluating what are trends and kind of have some rule set or criteria to define the trend. So Dow's being softer, not necessarily breaking that hard, but just kind of softer, okay? Now, some of you say, well, where's this chart? I sent you the link. I'll send it again. And what you're going to see is if you go to the fifth chart right there, it's right there. Now, if I pull it up, let's say the SPX and say, what does it look like? Well, today we're kind of dripping down. Now, remember, when you see these purple color candles, it's just losing momentum. And if you're losing momentum, things like covered calls, protective puts, collars, the investor might say, look, I'm going to protect my position. Now, if the investor says, I don't even do options, okay? They might say, look, I'm going to adjust my stops. And you're going to see me do a couple examples of that here today, okay? So if we kind of said the last one, which is the NASDAQ, do we see any major breakdown? Now, if we actually saw only orange color candles, not much of a pullback, only consolidation. If we saw orange and purple color candles, a little bit more of a pullback. And if we saw orange, purple, red color candles, a deeper pullback. So if you said, what do you want to see? You'd say, James, just give me the orange ones only, as that's really signifying we haven't pulled back that much and we're still up near the area of resistance, okay? So we're kind of seeing a uniform kind of market posture here. Everything kind of seems to be in a slight pullback, okay? Now, when the market is pulling back, nobody knows how low it's going to go. Nobody, okay? It's kind of a day-to-day thing as far as orders coming through. And so far, we don't really see a whole lot of hard selling. The keyword is yet. VIX, when we actually pull that up, zoom in on this. Now, usually if the market is pulling back, volatility moving to the upside. Now, I'm not sure if this is our favorite. Seeing the VIX with green candlesticks and a moving average crossover, ooh, that's not necessarily the greatest bullish signal you've ever seen in your life. Okay. Matter of fact, if you went back and said, when did you tend to give profits back? It's when that volatility is rising. And that's why many investors are probably considering adjusting stops, considering cover calls, protected puts, collars, etc. Maybe even applying some bearish trades. Now, are there any questions with that? Okay. Now, let me know if there's any questions. Let me give you an example of what I really mean by like stop adjustments. Okay. So when we talk about stop adjustments, and let me kind of bring this up here. So imagine example given that we have a stock, let's say Mo Altria, okay? And we're going to see that this is the trade price, this is the mark price. Okay, fine. And what we're looking at is in terms of adjusting stops, is we're really looking at the 8-day low, DL, 8-day low, and the 10-day low, okay? Now, we can visually see this on the monitor tab, but we could also see this as well on the charts, okay? Now, the one thing we want to make sure that we do is like, do we have stops in these positions, okay? Now, we can't really say, well, I'm just going to watch stuff, because what happens if you're gone for 2 days, okay? Now, what I'm going to do is, if you look at where the 8-day low is, a tighter stop, and you look at where the 10-day low, it's also at that same level. We are very, very close. We're about $1.30 away from where those stops could be set at. So if I went in here and said, okay, let's take a visual look. Let's go to not the second chart, not the third, we're going to go the fourth. Now, the one thing that we would have to say on Mo is there's been reason to maybe be not even have the position as of lately. Why is that? Well, it was just a couple days ago, the white line, that's your 8-day low, okay? The red line, that's your 10-day low, and the yellow line, that is your 20-day low. Now, what happened is, really, if you go back and visually look at this, we triggered, that was about what, June 7th, okay, somewhere right in there. That's when we actually fell down to that point. And then if you see that those lines go lower, is that a good sign or a bad sign? Well, if that line is bent down, the 8-day low and 10-day low are bent down, that actually means the lows are getting lower. You got to ask yourself, why am I still in the position? Okay. Now, if you look at where we are now, luckily it's come back up. The key word is a little bit. But the moral of the story is all those, whether you use the 8, the 10, etc., they're all sitting here pretty much at this low, and it's triggering right off that mark right there. Okay. It's actually this one right there. So it's 58.17. So one thing I'm going to do is just kind of show you this. Now, why do I like to visually see it on the chart? Well, number one is it's easy to, if you have like a stop, and I'll show you what this does. I'm going to right click on MO. We're going to create a closing order, and I'm just going to say with stop. Okay. Now, what I'm going to do, just for teaching purpose, I'm going to imagine that we have a stop at $55. $55, stop day GTC. Okay. Now, why do I like to actually have those days lows plotted? I'll show you. Confirm send, send the order. Now, what this is really doing is we're going to come back to the chart, and it's going to show. So if we had a stock position, repeat, if we had a stock position, and if I left click, do not click on the X, it will cancel the order. We're going to drag it up, okay? And so now what you're going to see is 58.17 and then let go. And once we let go, now you're going to see that we're moving up the stop to that price, send the order. Remember, that is a trigger to sell. That is not guaranteeing it's going to sell at that price. Send the order. Now, so it becomes it can be quick in terms of like stop adjustments. Now, if I actually also went back into this and said, well, what about Chevron? Okay, or let me actually even take let's go Chevron and we'll do Microsoft. 2 more of these, and we're going to talk about some new trade examples as well. So if I went to, let's say, Chevron, stock price, entry, 144.42. Where's the 8-day low? 141.91. Now, I want you to kind of notice something. When we have the entry price getting close to the 8-day low, we like to think as traders that, oh, look, now I'm only risking like $2.50 or so. But what's the assumption built into that comment? The assumption built into the comment is the stop triggers and it fills at that price of the stop. Factual? No. That's the plan. Could happen, but there's a risk of still a gap down. So what I'm going to do is I'm going to go to the charts again, CVX, pull it up, and here we go. So if we went to this and said, okay, where could we actually move the stops up to? Well, we have a stop on this. All I'm now going to do is I'm going to just take the stop down here. This is where the stop is right here, about 137. I'm going to move it up to about 139. Left click on that and just hold it down and then drag it up. Now notice it's not moving the target. It's just moving the stop. However, when you start getting a lot closer to the target, you might set those stop adjustments 1-to-1, one reward for 1-to-1 risk, or 1 reward to 1.5 risk. We are sitting within $4 of this, and just for time's sake, we're going to do that. If I just took kind of the quick numbers and said, look, how far are we away from the target? Once we start getting within 1 to 2% of the target, we're at 2.37, but we were higher than that in the last 2 days. We're trying to get another 354. Well, let's say the investor says, well, geez, if I'm only trying to get that last little bit here, I don't want to give it all back. And what I'm going to do is whatever I'm trying to make left, I'm going to actually risk potentially to the downside. What's the assumption in that comment? The assumption in that comment is that it fills at the stop price. So once you start to get within 1 to 2% of the target area, the investors choke the stops, okay? So how close to resistance do you wait? The investor might do. Well, 1 to 2%. If the price is within 1 to 2% of the target area, they then might consider the 1-to-1 reward risk ratio or the 1 to 1.5 reward risk ratio from the highest price, not when you saw it, from the highest price that it's been recently. So in other words, if I went back and actually said, hey, we were higher than this, and I was trying to go for 152.77, well, you could really take it from that price less 277 because it was higher. It's not just when you're looking at it. Okay, does that make sense? All right. Now, I just want to kind of show you the examples of stop adjustments, okay? Personally, I think those are the fun things to do in terms of managing the position, but I also want to just real quick, let's kind of talk about a new example, but then we're going to come back to, now the comment really came in from Art. This morning I gave the comment on oil prices being higher, given what's happening in Israel and Iran area. And I made a comment of sometimes I said, hey, oil might be a little high in the shorter term, given maybe some fear in the area and the world. We know that sometimes when you look at oil doesn't just go straight up and trend and trend and trend and trend and trend and trend, okay? It's not supposed to do that per se. It did that back in what, 07, went up to 147. I'm just saying in the shorter term, oil price, the price of oil in the short term could be a little bit overvalued in the short term. That's the key word, in the short term. And so sometimes if people actually think that there's maybe risk to supply, they bid up the prices in the short term. Why? Because they want to make sure that they're able to get the item, in this case crude, to run their business, like jets, like airline companies, etc. So I'm just saying keep an eye on that. I am not saying oil stocks, because those are not just tied to the oil price, they're also tied to the stock market. And if you look at the energy space, IXE, the IXE itself, if I pull that up just really quick, the IXE, what does it look like? The energy sector. The energy sector doesn't necessarily look like it's backing down. It's trying to really make a higher low right now. My comments were on the oil price, okay? All right, now what I want to do is I want to kind of take a look at a new example. Now, what I want to do is I want to go back to a stock. One of the stocks, so we're talking about trading a smaller account, and I want to kind of use, now here's the nice thing about trading a smaller account, okay? In trading a smaller account, you're thinking, how can I be capital efficient, do trades that are capital efficient, meaning not as much capital as buying shares of stock. Second, that I also have a built-in defined risk. Now, I want to kind of take a look at a couple stocks. One of the stocks that we're going to set an alert on, okay, keyword is an alert. An alert is not an entry. What I'm going to do is I'm going to right click on the chart, and what I'm going to do is I'm just going to say create an alert, okay? Now, if I say create an alert, okay, with, in this case, I could do with the drawing, what I'm now going to say is if we get at or below, okay, crosses above the price level, in other words, I'm going to just say alert me, okay? So if it goes up above that price, wherever you right click, that's the price. So Mondelez is one that's kind of built a support level and is trying to make some higher lows into the area of resistance. Now, again, a lot of people tend to be fearful of resistance, but if we're making higher lows into the area of resistance, well, a lot of times it can break resistance. Okay. Now, the one I am going to go back to is, let's go to Dash. Okay. And if we were looking, let's say Dash, this is a stock. If we kind of said, what do we see in terms of trend here? We see that we actually had a prior high there. And if we take that prior high and extend it all the way over to the right, again, what the technician is looking for is, do we really see these dots over time? Here's a dot, here's a dot, here's a dot. Now, you might ask, does this ever get old? Absolutely not, okay? If you were to say, look, does it ever get old even on a weekly basis? Absolutely not. Now, some of you are saying, can I get like 10 of those where the dots are going higher over time? The dots are really depicting a potential hold setup. And if those dots are getting higher over time, it's leaving tracks of proof of price action of really making higher lows. Now, today's price, what you're going to notice is we've peaked above this prior high. Now, if we're talking about trading a smaller account, now, does it mean the investor cannot buy shares? They could, just can't buy a bigger number of shares, okay? Second might be verticals, okay? Whether it's long call verticals or short put verticals. And I know Barbara talks about that quite a bit. And I talk about those actually on my class as well. The other thing actually could be is if we did a long call vertical, right? That reward to risk kind of more one-to-one majority of the time. Short put vertical, you really kind of have like a 1-to-3, 1-to-4 perhaps reward risk ratio, right? If you do probability, the reward is less. If the investor said, James, I am more confident that this might try to go to the upside, I'm going to go back to the trade tab and we're going to make sure we're in that margin account. There we are. Go to the trade tab. There we are. And I'm just going to type in Dash. Okay. Now, if we're talking about also trading a smaller account, and it doesn't matter, I mean, volume is very important. Stock volume is very important because the stock volume can then influence the options, okay? So a lot of times, or sometimes, I see that when someone says, hey, what do you think about this stock? I pull it up, and there's no volume, okay? Be careful on that. In our example, we like to see an average volume of 1 million plus. Okay, 1 million average volume. Okay, now what I'm now going to do is I'm going to go to the July expiration, 28 days, and what we're now going to look to do is look to buy an at the money call. Now, the at the money call, if we take a look at this, and for some reason I'm not sure if this is as wide, and it just moved as I pulled it up, but I'll also go down to here as well. Yeah, so what you're now going to notice is if I were to look at, let's say, the July 220s, okay, I got a bid-ask spread of about 70 cents. If I go look at, let's say, the August 220s, they got a bid-ask spread of, let's say, 50 cents. So what I'm going to do in this example, I'm going to go down to August. Now, one of the things you need to be very, very, very careful with is if your whole portfolio or a large majority of it is in one expiration, be very careful, okay? Because what's going to happen is if you get the direction wrong and all of your trades are in one expiration, man, it's going to be amazing or not that amazing, okay? So what I'm going to do in this case is I'm going to go down to the August, a little bit farther, but we always look for 20 to 50 days to expiration. This is 56, so it's not completely throwing us off. We're like 6 days over. If we said this was Monday, we'd have like 52 days, okay? So it's on the outer end, but not by much. We're going to right click right there. We're going to buy the 220, and then what we're going to do is sell the 230. What is the purpose of this trade? We're bullish. Why this trade versus the short put vertical? Well, remember when we did this trade, we wanted kind of more of like a 1-to-1 reward risk ratio. In this case, we have a right to buy the shares from now to expiration at the 220. The right is not free. Net, it's $5, 503 plus commission. And now what you're going to see is it's going to give us the break even at expiration. If you did the at the money call, okay, like you see here, you're going to now notice that if we, the stock would need to move up some just to break even. Stock is at 223.64. We're at 225.03. Now, if we did this, what I'm now going to do is I'm going to send this order. Now, we also kind of have to think about if we did lose $500, which could happen, how much would it be of the portfolio value? This portfolio is sitting at about 30, let's just say $32,000. If we lost 500 of 32,000, how much is that? Answer, 1.5%. Now, I don't know what the cap is for you, but that, like, based on one trade, that's probably the outer end, okay? Because if we got 5 trades wrong in a row, if that were to happen, which is possible, that's taking quite a bit. Now, if the investor says, I'm a little concerned about that, or I'm not sure if I want to take all that risk, could the investor set a conditional order to get out if we were to get at or below 213.42? The answer, yes. Okay. And what I'm going to do is I'm going to right click on that again, create an alert withdrawing, and we're going to say cross below. So when I right clicked, that's what creates the price, create. And now you're going to see if we get below the price, crosses below that price, let us know about that. Okay. Yeah. Now CS says as long as it's less than 2%. 2% kind of seems a little high to me. I mean, maybe everyone's different. Okay. And this is where everyone is different. There's no one shoe that fits all here. Some people might say, look, I'm fine with 2%. Others are like, look, I'll take a 0.5%. I'll take a 0.75%, 1%. Take 1%. 2% for many might be the cap. Okay. Now, what I want to also do is let's also go back to an example of a past trade. So in one of these examples, I want to bring up, so we talked about Mo, we talked about Chevron, we got that. I also want to go back down to an example of Boeing. Now I need to, Apple. This has been an example where we bought Apple, like the long call option, the 210, and actually sold the 215. So in this example, Apple did not go up enough. It just sat sideways. And now what you're going to see, and this is very important when we talk about trading a smaller account, that there is a built-in defined risk. Where's the current stock now? Well, the current stock now is at 198. Well, if you're below both strikes, there's no intrinsic value. No intrinsic value, and you're out of time, means max loss on the options. So what you're going to see is these should just expire worthless and drop off tonight. But the $270, it's already reflected in the balance. It's not like another $270 comes off tonight and now it affects the balance. That is already affecting the balance and has. Okay, so Apple did not go as intended. Boeing is under pressure with a flight crash. Okay, has 28 days remaining. Boeing is actually, McDonald's has been another one that has not gone in the intended direction. So normally in our examples, we let the probabilities play out. We had a plane crash, and we also had, for example, let's say a McDonald's stock that really dropped down through the area of support. Now, I'm going to kind of leave it up to you from your experience of how you would like to trade. But what you're now going to notice is once we drop down below that support level, it's pretty much been I-65 south to the downside. So Sometimes on these vertical trades, you could say, look, I'm going to set a target or a stop or a trigger to sell, I should say. But the biggest actually thing is you have to understand is you're not letting the probabilities play out. I have my own experience. You can get your own. In our examples, we like to let the probabilities play out, but that doesn't always mean that the trades work, okay? So what you're now going to notice is on Mickey D's, that is also down 367. Now, other ones that weren't as bad, what you're going to see is PM, $210. And what you're also going to see is if we looked at, let's say, Tesla right there, about 120. So some work and some don't. I want you to kind of decide for yourself is, do you want a conditional exit? Okay. So if you want to kind of use technical analysis with options, let's kind of show how you do a conditional exit. In other words, you're going to put on a probability-based trade, but then also, like a stock investor, set a conditional exit to get out. Now, what I want to do here is I want to pull up just real quick a position, and let's go back to a stock like TTWO for just a sec, okay? So let's say the investor said, James, I want to get in a position, and let's say the investor decided, they said, I want to do a short put vertical. I want to try to play the probability, but if the price went down below a certain area, I don't want to stay in the position. How do we set up that conditional order? Well, what we're going to do is going to go to TTWO in the paper money account. Now what I'm going to do is I'm going to look at the July options and the August options. So a lot of times as investors, we might say, well, tell me which expiration I should do. Well, you can't give an answer to that because if I said buy the options or sell the options at 30 days, how do you know those options are liquid? You don't know that. You'd have to look, okay? So there's not one right answer because we're assuming that every stock you look at has ample liquidity. That's not true, okay? They might, now, so we give a range. Minimum we talk about, if we talk about monthly options, 20 to 50 days. You got the July options. If we sold the out of the money puts, the strike below the current stock price, or in this case at the money, what's the open interest like, okay? 30 cents in the bid-ask spread, open interest of 92. Bid-ask spread actually 20 cents, 633. The thing there is the delta is 25. So when we look at the delta, okay, stating the probability of the stock being below the strike price by a penny, also stating actually if the stock goes up or down $1, the options move by approximately 25 cents. If you take a look at that, that might be a little lower than maybe some like, and that's going to influence the credit that you receive, okay? Now, if we went down and said, well, wonder if I could do these ones, okay? Sell, let's say, the August 230. Well, if you sell the August 230, you still have, if we look at the open interest, 257 on open interest, not massively traded here today, at least today. And what I'm going to do is on this one is I'm going to right-click on that, right-click on the 230. We're going to go to sell. Now, the goal of this trade is we're going to put the trade on, but what we're going to do is we're going to say, look, get in the trade, but then exit the trade if it goes at or below a certain price. If we go to sell and then vertical. Now, if we did this trade, there's the credit for that. Now, if you look at this, this is a $10 wide spread. And if you look at the reward to risk ratio, 280 divided by, let's say, 720, it's really like a 1-to-3 reward risk ratio if you really bring it down. Well, if we take a look at this, let's say the investor were to say, okay, I'm going to get in, note the commission as well, but then where's the potential exit? So this is a question for everyone. If TTO started to go down, at what point would you say the trend might be reversing? Okay. Now, some of you might actually say a comment like James 237. That's really close. If we actually also said a comment like James, if it goes below 231, that's also really close. That's a $9 move on a $240 stock. That's not much. That's like 2%. And if we said, well, James, if we start going down below 224.83, that's a $15 move on a stock that's 240. And if we said, well, how much is that? Well, a $15 move on a $240 stock, that's like a 6% move. That's probably about the closest we would set the conditional exit, okay? If you set really close stops on verticals, you might not be fully understanding how the verticals work. Probably the jewel of the verticals, if you will, the good thing, is verticals are not as sensitive, lower delta, to the price movement, up or down, which is good. You can allow more price fluctuation and try to ride that trend. Now, what I'm going to do in this case is I'm going to set the conditional exit at 222. So if I brought this back up and said, okay, what we're going to do, we got the order there. We're going to say single order, first triggers SEQ. We're setting up a conditional order that if it goes down to that price, get out of that vertical. Now, first triggers SEQ. Right click on the line, create opposite order. Okay, so that's not too bad. First triggers SEQ, fine. Step 2, go right click on the line, not that bad. Create opposite order. The opposite order is just saying get out of it. We have it at the first rows is a credit. It's in red. We're buying it back. We're going to go limit market data GTC. Not bad. That's a conditional order. And the condition is going to be based upon the price. So we have TTWO, method mark, less or equal to. And what I'm going to do is I'm going to type in 222 bucks. Now, if you feel like you're not good with kind of this, that always confuses you, don't worry. We can see down below, if the mark price of the security is less or equal to $222, exit the position at their what? At their market prices, okay? Now, how could you really kind of see potentially what that loss could be? Well, if you right click on that line and you say, let's analyze that trade, what I'm trying to really do, just quick math in my head, is what's the delta on the position? The answer? 10. Now let's make an assumption. We're at 240 and it goes down to 222. Okay? So how many points is that? Well, if our math is right, then that would mean that the stock would go down to about 18 points. Okay? So that's the stock. Okay? Stock price. Now, that's a stock movement. But we need to actually now tally that to options. Well, all we're going to do is just say, hey, we got a 10 delta. And now let's translate it to the options, okay, position. If the stock goes down $18 and the delta is, think of that as the conversion, okay, 810, well, that loss might be in the ballpark of, let's say, $180. Now, is that factual, actual? No. What might influence how bad it might be? Volatility movement to some degree. Yes, it is short volatility. Okay, noted. The other factor could be is if it takes longer to go down there, the better, because it's positive time decay. Okay, as it is held longer, the options erode. Okay, assuming volatility stays flat, and the loss might not be as severe. Now, what I want you to do is I'd like you to practice 2 to 3 trades with conditional orders, okay? And the conditional order is really built upon the stock price. If the stock price actually goes down at or below a certain point, the investor is saying, I'm willing to exit at a portion potentially of the maximum loss. Now, are there any questions there? Now, this is very important that we kind of... Now, Art says, I don't like conditional exits on short put verticals. Now, here's the deal. Everyone can have their own experience, right? Art and me, Art might be my brother from another mother. Okay. Now, here's the thing. Does that mean that Art always likes to do that? Or let's say some investor always likes to do that. Well, there's some reason to have conditional exit. Maybe the VIX is low and you're concerned the volatility is going to go up in the marketplace. The investor might say, look, I just want to get exited out because I don't want to hold positions through a pullback in the market. There are reasons to know this outside. I don't normally like to do that, okay? So that's why I'm showing you this. So if there wasn't a time where the investor might say, when might the investor do a conditional order like this? It's when the VIX is low and diverging, and that divergence is leading to a moving average crossover. What the investor is saying is, look, if I put on a whole bunch of short put vertical trades and volatility in the marketplace goes up, that means price most often is going down, which would hurt these positions, and the volatility is going to go up. And if the volatility actually goes up, the time decay the investor thought they were actually going to capture, they don't tend to capture it. The volatility is outpacing the time decay. It's hurting, it's spiking the value of those options, and they're not really realizing the time decay. Okay. Now, there's been times where the investor says, I was doing really, really, really well until what? The VIX went up. And so if the investor puts on trades when the VIX is low and diverging, and maybe that divergence is leading to a moving average crossover, there's reasons why the investors might say, look, I'm testing the entries, but they're with a conditional exit. Okay. And that's where there's like a science, right? And there's like the art. What I just said was the art of kind of saying, look, the risk of putting on bullish trades when the VIX is this low is if that entry starts to crumble, it could take back a lot of the good ones that we did in the last, let's say, 30 days. Matter of fact, when do people tend to be the most bullish? They tend to be the most bullish when the VIX is the lowest. So they tend to stack positions on at the very wrong time. They were just barely getting in when it was really going up. And then when they feel like they're late and now they have more confidence, now they stack it on. And that's why the investor probably wants to consider completely reversing that. When the VIX is the highest, consider stacking it on. And when the VIX is the lowest, they're just putting on small number of positions. Usually things in life are usually always or most often the opposite of what you think, or the opposite of what you want to do or think to do. All right, chew on that. But now, what I also want to do is let's kind of look around some stocks, just kind of that we're going to keep an eye on. Caterpillar is actually another one that is actually staying above the 356.20. Some investors might say, James, I might consider a vertical trade on that, but I'm going to do a conditional order to get in. Meaning, if they were to actually say, I'm going to get in if we get above 364, they could do a conditional order. It's like pending, right? Keep an eye on Caterpillar. That's one that's still holding the breakout area. Now, we also see, for example, on the Datadog, which you pointed out the other day and did a trade on, it's down today. But a good technician is not fearful of the red candle as long as it's still above the moving average. Red candles above moving averages, what does that even mean? It just means it's exhaling, okay? And as long as we stay above the midsection of that large green candle, this could be, for some investors, just trying to buy on the dip, on the price action, okay? Some investors might try to put a pending order right at the midsection, or they might just try to be manually buying in to the dip, thinking it could potentially hold. Datadog is actually still there. Now, if we also take a look at MCHP, the other one we brought up, Microchip, kind of still at that area, kind of a little hammer here on the right-hand side. Could it try to take another run to the 72? Marvel, we talked about, just want to follow through. This is the other one that's trying to fill the gap as well. Red candle, but still above the moving average. Notice for the 599th time, day one, breakout, day two, red candle. How many times have we seen this before? Like a lot, okay? So a lot of times that second day tends to be a red candle, and then all of a sudden, watch and see if it starts to bounce. The red candle, as long as it's above the moving average, it's just a red candle, okay? Red candles are the friends, they're the friends of the bullish investor who's trying to get in closer to support, okay? And what you're now going to notice, if I had a little bit more time, Marvel might try to be like a bounce opportunity come Monday, Tuesday, Wednesday. Keep an eye on that, okay? Now, I'm out of my time here today. I don't want to go over the certain allotted time. And so some of you remind me of that, and I appreciate that. There's just so many good things to talk about. Now, what I want you to do is I want you to practice conditional orders. Number one, a conditional order like I talked about on Caterpillar. In other words, entering the position, whatever strategy that you choose, but it's pending on the price getting above a certain level. Okay, so I want you to practice that. The second one I want you to do is practice getting in an order, but then putting a conditional exit if it were to go at or below. Now, the first homework assignment is kind of like a buy stop, but just with an option. And the second one is just kind of like an option trade. It's not a stop, it's a conditional exit. And the condition is the price, okay? The price falling below the price level that you specify. Now, I'm out of my time here today. I want to say thanks to Connie for answering those questions in chat. Now, a quick reminder that, remember, June 24th, we're actually going to have that special event right at 1 p.m. Eastern. Feel free to join us there. We look forward to seeing you there. Also want to give us a quick reminder that if you have not subscribed to the Trader Talks channel, do so. All of our classes outside the 2 ETF classes are posted, so check those out. And also remember that Barbara is going to be in New York next week, so I will be back next week. I will be looking to see if I missed any of your other questions, and we could circle back on those as well. Now, also remember with what we discussed, it was done for example, illustrative purposes only. Thanks to all of you, and stay tuned for our next webcast coming up right at the top of the hour. Take care. Bye-bye.